People say to me, well, Rick, the gold price has fallen. And I say to them, well, as a buyer, that's a good thing, isn't it? Would you rather pay $5,000 for it, or would you rather pay $4,000 for it? If gold reverts to mean, gold and precious metals related securities reverse to mean, demand increases fourfold in the largest savings and investment country in the world. And that's what I think is going to happen. People not owning gold and not owning gold equities are a total mystery to me. People say, Rick, what would make you sell your gold? No problem. I'll tell you. You'd have to balance the U.S. federal budget. You would have to make political accommodation to pay down $40 trillion in debt. You would need political accommodation to solve the $120 trillion in the net present value of unfunded entitlement liabilities. And when the interest rate goes up, the capital expense of developing additional productive capacity in copper, in iron, in oil becomes more expensive. When I saw silver lock limit up every day, experience told me that what I had to do was sell. The reason to own the asset disappeared. I had a hyperbolic chart. I had to sell. Why do I say the sure money's ahead of us? Let's pick one commodity which is stupidly underowned, which is gold. People say to me, well, Rick, the gold price has fallen. And I say to them, well, as a buyer, that's a good thing, isn't it? Would you rather pay $5,000 for it, or would you rather pay $4,000 for it? If you'd rather pay $5,000 than $4,000, I have a house to sell you. Why wouldn't people buy gold the way they buy tuna fish or coats? Then I say to people, the price is down, is it? I began saving in gold in the year 2000. Gold was $256 an ounce. Now it's down to $4,100. Doesn't feel like down to me. But that's rear looking. Let's look forward, which is what your audience must do. History teaches us that gold does well during periods of time when investors and savers are nervous about the maintenance of their purchasing power in traditional savings instruments. We're in the United States, so let's talk about U.S. 10-year Treasuries. The U.S. 10-year Treasury, the world's premier benchmark savings instrument, yields 4.6. In a currency that I would argue is depreciating in terms of purchasing power by 8 to 10% compounded. If you do conventional arithmetic, you're making 4.6 in a Treasury. If you do unconventional arithmetic, you're losing 4% a year. You buy a U.S. 10-year Treasury, you lose 4% a year compounded for 10 years. It means that you put up $100,000 and you got back $50,000. Not a very good deal. Gold, now that it's down, in the last 26 years, has increased at 8% compounded nominally in US dollars.
Markets celebrate falling gold prices, yet long-term purchasing power keeps moving in the opposite direction. Rick Rule notes that a 4.6% Treasury yield becomes a negative real return if inflation silently compounds above it. The real debate isn't price volatility, but whether cash is preserving wealth at all. Savers focusing only on nominal returns may be accepting losses they never calculate. Next, Rick Rule exposes why Wall Street's definition of safe breaks down under sustained currency debasement.
Which, put differently, has maintained its purchasing power. That's precisely what gold is supposed to do. My belief, and I can bore your audience if you want with all the arithmetic, is that the US dollar will duplicate its performance in the decade of the 1970s, which is to say it will lose 75% of its remaining purchasing power in the next 10 years. And gold, I think, will maintain its purchasing power. Gold will today, as it has always done, buy you a very fine men's suit. Maybe not at a hotel this expensive, but at a reasonable place. It'll buy you a very fine men's suit, an ounce of gold. And 10 years from now, it'll buy you a very fine men's suit. That same men's suit in US dollars will probably be a $15,000 suit in 10 years. So gold will maintain your purchasing power. Now, let's bring that down to you. Let's use you parenthetically because you're probably smarter than the broad population. The market share of gold and precious metals related securities in the United States relative to other savings and investment assets is 0.5%. Figuratively, this is a pimple on an elephant's behind. The 4-decade mean market share is 2%. If gold reverts to mean, gold and precious metals related securities reverts to mean, Demand increases fourfold in the largest savings and investment country in the world. And that's what I think is going to happen. People not owning gold and not owning gold equities are a total mystery to me. And we could go sector through sector through sector in extractive industries, and I could make a similar case. I wanted to pick on gold simply because gold is identifiable to many people.
Really great bull case that you're outlining there.
Gold is dismissed as outdated, while less than 0.5% of US investment assets are allocated to it. According to Rick Rule, even a return to the long-term average allocation would multiply demand several times over. That exposes a disconnect between public narratives and actual portfolio positioning. Investors ignoring this imbalance may be assuming today's allocations are normal when history says otherwise. Next, Rick Rule reveals why a simple reversion to historical ownership could overwhelm available supply.
Well, something I would love to pull a thread on is, you mentioned gold, of course, retains purchasing power. If you were to go back a few hundred years, you could buy a fine suit, and that's still the case today. Is there still an opportunity, as in sometimes in history has occurred, for gold to gain in relative value compared to other assets over the next few years, and what drivers would drive that forward?
There is absolutely the chance that that takes place. But I'm trying to make the case from a conservative point of view. I'm trying to tell you that your downside is upside. I'm trying to give you a case where the answer begins with when, not if. Can I give you an if scenario? Of course. If you look at the last period of gold's hyper outperformance, it was the period 1970 to 1980. During that period of time, the US dollar lost 75% of its purchasing power, and gold ran in price 26-fold. It is estimated, although statistics don't exist, that in 1981, precious metals and precious metals securities represented 7% of the savings and assets of Americans versus 0.5% today. If gold didn't revert to mean, which is to say a 2% market share, and went to a 7% market share, there isn't enough gold on Earth to fill that demand. That's an if. Okay, the point is, I don't need to make the upside case to make my case. I need to make the downside case. And I challenge any of your listeners to challenge the downside case. People say, Rick, what would make you sell your gold? No problem, I'll tell you.
If history rhymes again, the biggest risk may be assuming this cycle cannot resemble the 1970s. What Rick Rule is highlighting is that his investment case begins with downside protection, not extraordinary gains. That distinction matters because preserving purchasing power requires fewer assumptions than forecasting explosive rallies. Investors who overlook asymmetric protection often discover its value only after confidence in paper assets fades. Next, Rick Rule unravels the conditions that would actually convince him to sell his gold.
You'd have to balance the US federal budget. You would have to make political accommodation to pay down $40 trillion in debt. You would need political accommodation to solve the $120 trillion in the net present value of unfunded entitlement liabilities. You need to find a way to say to me, an old guy, yes, you've paid into Social Security for 60 years, but there's no money, so you don't get any. And you'd have to have a positive real interest rate. If the purchasing power of the US dollar is declining at 8% compounded, I would need at least 150, maybe 200 basis points yield on top of that, which is to say, the US 10-year Treasury would have to be yielding me 10. The first mortgage rate in the US would have to be 12. The prime interest rate in the US would have to be 11. How long do you think the American taxpayer would stand for that? The probability of the circumstance occurring that would cause me to sell my gold within 10 years is, I think, functionally nil.
It's an incredible point that you're making. Of course, the fiscal responsibility, the demographic side of the equation, and keeping up with this debasement would be incredibly impressive for any asset class. And I really struggle making the case for almost any other than gold to actually be able to keep up to the massive amounts of money printing that you're outlining here.
Well, again, if you dial yourself back to the decade of the 70s, assets that are denominated in dollars when dollars are devaluing become nominally more expensive. It's important that people realize that. The second thing that happens is that later in a cycle where inflation occurs, the interest rate goes up.
The market prices optimism, while government balance sheets still point towards structural strain. Rick Rule's argument suggests meaningful real interest rates would require politically painful decisions few elected officials appear willing to embrace. That gap between fiscal reality and market expectations is where long-term portfolio risk quietly builds. Investors betting on effortless debt stabilization may be underestimating the scale of the challenge. Next, Rick Rule reveals why inflation changes commodity pricing long before headlines admit it.
And when the interest rate goes up, the capital expense of developing additional productive capacity in copper, in iron, in oil becomes more expensive, which favors the incumbent producer. If your ability to add incremental supply becomes more expensive, you add less incremental supply. So the existing supplies become rationed by price. That was something we learned in the decade of the 70s. People look at the increase in the oil price over the course of the decade, and they blame the Arab oil embargo. They forget the fact that society underinvested in oil for 20 years before that decade. And they forget that the capital expenditure associated with developing new supplies increased exponentially as a consequence of inflation during that decade. They don't understand the reasons behind the price appreciation. And the reasons behind the price appreciation that occurred in the decade of the 70s occur today in the same fashion.
I was going to say that sounds like a situation very familiar to the oil situation today, which I would love to park for just a second. Perhaps we can talk about the gold miners, which of course people tend to think they provide leverage to the underlying commodity as they're the producer of it. Cost would hopefully remain flat, but in a money printing environment, debasement environment like you're outlining, costs will rise.
That's correct, and are rising, not will rise. It's important that you note that. It's important that gold mining investors pay attention to the inexorable increase occurring already in all-in sustaining costs. As an example, open cut mines in particular are extremely energy intensive. An increase in the oil price hits, and it doesn't hit you 3 years from now. It hits you 3 months ago. The second thing that's happening, and the industry's noted this in industry conferences, is that the inputs with regards to building mines are increasing.
Commodity shortages rarely begin with empty warehouses. They begin with rising costs that quietly discourage new supply. This is where Rick Rule's thesis shifts from gold prices to production economics that most investors ignore. Inflation doesn't simply raise prices, it slows future supply growth before demand fully responds. Portfolios focused only on spot prices may completely miss the tightening cycle underneath. Next, Rick Rule exposes why rising construction costs reshape mining valuations faster than most models predict.
In price at about 10% compounded. So what does $1 billion mine build today, a year from now is $1.1 billion. It's important that people understand when they're discounting future cash flows that they need to increase by at least 10% compounded the input costs that they're looking at.
So perhaps we can then talk about the right circumstances that you outlined there for the juniors to really potentially cap up, because like you've outlined in the past before, juniors that have gold in the ground but don't extract them, they really, well, if they have gold in the ground, perhaps they should trade up with gold, but if they just have moose pasture, no reason they should trade up if the gold price is trending up. So what mechanics would allow really that move higher, that gap higher that you've outlined potentially?
If, just sticking with gold, forgetting the rest of the universe, if gold reverts to mean, if demand for precious metals and precious metals related equities reverts to mean, demand for this class of assets increases fourfold, and there isn't enough supply. When that happens, gold gets used up. The best of the best gets used up. The best of the rest gets used up. The single asset producers get used up. I mean, their market caps. Doug Casey describes a bull market as trying to siphon Hoover Dam through a garden hose. When it gets down to the tertiary assets, and there's no assets in the world more tertiary than junior explorers.
Everyone wants junior miners after they surge, yet almost nobody studies the supply chain before the move begins. Rick Rule notes that sustained demand eventually exhausts quality producers and forces capital into overlooked explorers. The market rarely rewards speculation first. It rewards scarcity after stronger assets disappear. Investors chasing momentum often arrive only after institutional buying has already moved upstream. Next, Rick Rule reveals why the smallest explorers can become the biggest beneficiaries of capital scarcity.
The price response that you get is truly, truly, truly insane. You suffer through very long droughts, and you suffer through really, truly exquisite risk. And it's also very labor intensive to take advantage of. But when you get paid, which is a once a decade event, if you're lucky enough to be there ahead of time, you get paid in spades. Now, I don't believe in the thesis long enough to own all of Palisades, to own the whole company. If I did that, it would be incumbent on me to participate, and I'm not going to do it. But the idea that I can allocate enough money to it that if I lost all the money, it wouldn't change my decision as to have breakfast, in return for which I got some young guys who were working hard who could deliver me a 10-bagger.
So I would love to get your sense. Of course, we've seen a moonshot higher for silver since then and subsequently a fall back down to some kind of reality. How close are we back to the reality on the ground?
I don't know. I bought silver because it was hated. And I didn't buy it as an investment. I save in gold. I maintain liquidity in US dollars, but I save in gold. Silver is different for me. Silver is a speculation. I bought silver because it was hated. And I thought if the hatred dissipated, that there would be a price response in silver. I also, as a consequence of being an old man, having watched these cycles happen many times, knew absolutely positively that if we had a precious metals bull market, it would be led by gold,
The biggest gains often emerge from positions investors can emotionally afford to hold through years of disappointment. According to Rick Rule, gold serves as savings while silver belongs in the speculative portion of a disciplined portfolio. That separation reduces emotional decision-making instead of chasing every rally. Investors treating every precious metal identically may be increasing risk without realizing it. Next, Rick Rule exposes why leadership eventually shifts from gold to silver in major bull markets.
And that when the momentum in gold attracted the generalist investor into the precious metal silo, that when that happened, market leadership would switch to silver. I don't know why it does. I'm not that smart. I just know that for the prior 4 precious metals bull markets in my life, that's what's happened. So I theorized that if I was able to buy silver, that I would get a bump when hatred disappeared, and then I would get a second bump when market leadership traded to silver. And it happened. A third thing happened. We were confronted in early January by a hyperbolic chart. Whenever you see a hyperbolic chart, you sell it. No exceptions, unless the hyperbolic chart is the consequence of a news release that's company changing. But if you see a sector chart that's hyperbolic, you always sell it. The Canadians refer to that as a hockey stick graph. The visual is that the backside of a hockey stick is just as steep as the front side, but it's a lot less fun if you're wrong. And so when I saw silver lock limit up every day, experience told me that what I had to do was sell. The reason to own the asset disappeared. Silver as a speculation had less upside relative to downside than other asset classes that were speculative. And I had a hyperbolic chart. I had to sell. The thinking might be instructive. I looked at my silver and I said, okay, this occupies a speculative part of my portfolio and it's used up my reasons.
The most dangerous rallies are often the ones investors mistake for confirmation instead of warning. What Rick Rule is highlighting is that parabolic moves usually signal exhausted momentum rather than unlimited upside. Institutions often reduce exposure while retail enthusiasm reaches its highest level. Ignoring that behavioral pattern has punished investors across countless market cycles. Next, Rick Rule unravels how he redeployed capital after exiting silver without abandoning the sector.
Are there other speculations that seem more germane? What I decided was to take some of the money all the way off the table, and I bought physical gold with it. I called it savings. The only other asset class that felt hated to me was oil. So I took 25% of the money and I bought oil stocks. And I took 50% of the money and I bought silver stocks. The thinking was as follows: if I was wrong and the silver price continued up, the silver stocks would benefit. By definition, if silver traded sideways, I wouldn't make any money. But the silver stocks were priced at $85 silver as though silver were at $42. So I had a cushion. So if silver went sideways, I'd make no money in silver, but I could make money in silver stocks. And if silver went down, because of the implied discount of the equity price relative to the silver price, I would lose less in the silver stocks than I would in silver. That seemed to me to be a much more germane speculation, arithmetically, than owning an asset class where my reason to own it had disappeared.
Well understood. And perhaps we can also talk about the value proposition that silver miners offer today. Are they still being priced at around $40 silver, or have they now moved a bit higher?
Understand that most of the silver miners today are valueless.
Smart capital rarely exits a sector completely. It simply moves to where the risk-reward has improved. Rick Rule's argument suggests portfolio construction matters as much as asset selection during volatile commodity cycles. Institutions constantly rotate between bullion, producers, and related sectors instead of making all or nothing bets. Retail investors often overlook that flexibility until after valuations have already shifted. Next, Rick Rule reveals why some silver miners face competition that most shareholders never consider.
Miners or juniors?
Well, even some of the junior miners. There's some silver mines that are extraordinarily marginal. And they're competing against mining companies that produce silver for free. If you are operating a big porphyry copper deposit, the cost to extract silver is really putting a silver extraction unit on the back of your mill stream. The mining is paid for, the processing is paid for, the grinding is paid for by copper. And all you have to do is take the silver out of it. So primary silver producers who are producing silver for $35 an ounce are competing with BHP, who are producing silver for 50 or 60 cents an ounce. That's an ugly business. So when you buy a silver miner, you have to think in your own mind, what is the net present value of the silver stream? How is that net present value likely to change? And in particular, how much risk do you have in a declining silver market environment? Because you're competing not with other silver producers, rather, relatively, you're competing with recyclers and copper miners.
Not every silver producer benefits equally when silver prices rise, and cost structures determine who survives downturns. This is where Rick Rule's thesis shifts from metal prices to competitive economics hidden beneath headline production numbers. Low-cost byproduct producers can reshape the industry's profitability without changing silver demand itself. Investors ignoring those dynamics risk confusing rising metal prices with rising mining profits.